Welcome to the Dwayne Kerrigan Podcast, and I'm your host, Dwayne Kerrigan. With 35 years in business and close to 30 ventures across 12 industries, I've seen a lot. Amid the celebrity allure of entrepreneurship, many exceptional entrepreneurs remain shadowed. Here, I team up with these hidden talents to unveil their challenges and successes. Dive in with me to unearth entrepreneurial gems, learn from our experiences, and get educated. Hey guys, thanks very much for tuning in. This is the second conversation with Jaime McKenna. So if you didn't catch the first one, go back. It's a great conversation about struggling from literally nothing up to growing herself into running a multi-billion-dollar fund in the real estate industry. But we talk so much about honest conversations and leadership and mental health and outworking imposter syndrome, et cetera, et cetera. It's a beautiful conversation. She's so open and honest. Here's part two, where we talk a lot about the real estate industry, you know, why people aren't prepared for what's coming and what some of the opportunities might be in the future. So guys, thanks so much for listening. We appreciate you sharing and liking us, and God bless. Enjoy the conversation.
You know, I remember, Dwayne, I think it was the first time we met. I'll never forget this, is I actually had done a termination meeting right before I walked in, and I described myself as the ice queen. And then I'm like, God, Dwayne's going to he's going to think I'm an ice queen. I'm not an ice queen, I swear. I'm ice queen moments, but.
Yeah, well, we all do. We all have to slide into certain identities. I remember that. I remember that meeting. It was at your office, right?
That's right. That's
Yeah.
right. And it was like, way to make a good impression as I walked
No.
in.
Yeah, well, I don't take those things for, you know, I don't take anything like that literal anymore. I mean, I might have years ago, but now it's like, you know, people have their own path, and we're all on a path. Like, guys, we're all on this unbelievable path. And I'll ask you this question. Did you ever think that when you graduated university that you would be in the position or place that you are now at
No.
any level? Right?
No, I didn't. And I would say I also suffer from imposter syndrome even today. Like, I always, like, you know, Carl did the podcast before me, and I teased him. I'm like, why did you go before me? Because you sound so smart. And now I'm going to go.
Eloquent, eh?
He's so eloquent.
God,
and he's talking
so
about like philosophy and his global experience. And I'm like, oh, I'm over here eating glue in the corner. But like, yeah, I continue even today. I have that imposter syndrome. Am I smart enough? Am I capable enough? And did I just get here out of luck and being in the right place at the right time, which is always part of some of our success. But, you know, like you mentioned the CEO and the residents at Trent, and a lot of that is actually mentoring students coming out of fourth year. And I must have been asked the same question over and over again. How do you know you took the right job? Like, what if I take the wrong job? And I'm like, guys, I didn't know anything other than I had to put one foot in front of the other, and you need to take the pressure off yourself. And so when I came out of university, all I knew is like what was immediately in front of me. And it was a building block and a building block at a time. And I had a vision, but I was also prepared for that. You know, maybe I was going to be working behind the bar for the rest of my life because that wasn't going to work out for me. Maybe I wasn't smart enough. Maybe I wouldn't get my CPA. So it's that constant contingency plan for me.
It's interesting, you know, when you say that, especially about the you know, the fourth year graduates and stuff. But when, like, there's so much, people are like, and I get it. I mean, I'm not saying it's wrong, but there has to be two levels of understanding, I think, in that is, I have a plan and I'm going to execute the plan, but I need to be flexible. When I was speaking last night, you know, one of the things I talked about was, you know, the thought process that only the strong survive, or, you know, the Darwin theory of survival of the fittest. It's not that is not, in my opinion, not my belief system. My belief system is those that are most flexible or adaptable are the ones who survive. And so as you are transitioning through your business, your enterprise, your entrepreneurial journey, your career, your career path, your corporate career path, being flexible and adaptable and being able to move. And you talked a little bit about it earlier, and I forget, I'm just looking up the word that you used, but I isolated the word as awareness. And I think reflection, you used the word reflection. I kind of slotted the word awareness is what it meant to me. But it's like when you have that reflection time and you have that awareness of your surroundings and what the environment is creating, and you don't let fear drive your actions, which I think is like kind of like a bit of a bumper sticker of what we've been talking about, is like you have faced your whole process with courage. I'm sure there's been fear, but you've not made decisions out of fear. We all make a few, but overall, you've probably made most of your decisions based on courage and a path forward. And courage doesn't mean that you know you're going to be right. It just means that you don't know and you still take the action required. And so I think that anybody who's listening to this podcast is, and you know, we potentially, and I want to talk to you about this, is we're potentially moving towards difficult times. Like we don't know. It's very uncertain what that we know. And we don't know what the path ahead is because it has not yet been forged. And specifically in Canada, we're waiting for an election right now. By the time this airs, it will probably have already happened. But there are some uncertain things happening around the world, both from, you know, an economic perspective, but also from a social, political environment as well. And all you can do is rely on that courage to take the action going forward. I don't know where I was going with this, but just
No, but you're right. It's like, you know, people get so caught up in the rhetoric that is going on right now. Can you believe Trump said this and Carney said that, and they get in this spin cycle, but they're not moving forward. And you're like good leaders, people that are going to progress, like it's okay, what do we push forward? What are we going to focus on? Like I always say, okay, right now, what I can focus on is helping fix the housing crisis and finding opportunity within those actions, because that's a real thing. I can't figure out what Trump's going to say tomorrow and whether somebody's going to sign a lease in an industrial building because the supply chain's all messed up. But I can figure out that we have a housing shortage. And it's just, I just use that as an example that in this time of uncertainty, unprecedented uncertainty, where we normally would be like, okay, we're 2 years coming out of a cycle, we should start to see green shoots. These are the things that should happen. Every time that happens right now, there's a disruption. And so as a result, we have to just keep moving forward within the opportunities that we have. And I use that description again. I'm in a very narrow corridor of opportunities because we're in an uncertain time. And hopefully things eventually will turn around and our corridor widens and there's more opportunities. But sitting there and spinning on rhetoric is not going to advance anything.
No, it's so true. And I would also say sitting in rhetoric and sitting in judgment. You know, it's we talked a little bit about this with Carl on the podcast, but I get worried when, you know, I see this, you know, judgment between like, and I'm not for or against Trump. I'm not, you know, for like, there are lots of considerations here to take in. And what I don't think we can do is rely on the past to be the path. There's always a new path. There's always a way forward, you know, and that's where we have to focus on. I can't be in the mind of a Donald Trump, or I can't be in the mind of Zelensky or whatever, and where they are and where their position is. But all I can do is control what's in front of me at the moment. And the worst thing that we can do is fall into the trap of judgment and rhetoric, because it is not going to get us moving forward. And then that's where the pain is. Like if there's pain is in the past, you know, you've got to be making progress. And so it actually, like we were talking earlier about the real estate market, and you had actually made a comment about, you know, you're in a time right now where you can't buy or you can't sell. Because I will just say, like, and correct me if I'm wrong, but in an organization like yours, like you have organizations that are funding your investments. and you're a vehicle for them to, capitalize. And whether that's the pension fund or whatever it is. And in times like this, you're relying on that money to flow. And in these times, that money is not flowing. People are very uncertain and they don't want to, so they feel like in these times, they're like, look, we'll pull out in cash and we're going to hold back on making investments. And then money doesn't flow. And that's how recessions happen. And interest rates, then need to come down in order to get money to flow because it takes the risk off the table. Correct?
That's right. That's
Okay.
right. Yeah. So you're exactly right. Is that so? We're backed by pension money, and we invest on behalf of pensions. And I mean, depends on your strategy. And our strategy was very much like build a pipeline of development, so that in a time right now where capital is tighter, we still have a lot of work to do. We still have to continue to build, and we've made conscious decisions to continue to build when others aren't. But if you're living in an investment cycle or an investment strategy where you cannot move forward with your business in any way without raising capital, you're in a very difficult time. And so, your next deal, you can't do it, or your next building you can't proceed with without finding capital. This is probably one of the most challenging times in 30 years.
So can we shed some light? Like, where do you think, I'm curious where you think things go, or what the opportunities might be in the future here? Because, and I kind of just mentioned it earlier, there's obviously there's residential and condo kind of markets. There's the industrial and warehouse markets. Like there's building even for residential. I mean, and this goes right down to the level of, the kids who are coming out of university. They've been in their first job for a few years. They're looking to start a relationship. They want to buy their first house, and the affordability has gone up and supply has dropped. And it's just as, then COVID prices, like during COVID, it jacked up the cost of building and therefore the cost of housing. What does this look like in the future? Or what are the possibilities that it could look like? I mean, nobody has a what do they call that? A crystal ball.
Yeah.
Sorry.
I wish I had one.
Yeah, no kidding. But I'm just curious from your perspective on a few of those things.
It's a fascinating point that we're in the cycle, and I reflect on this all the time. Probably one of my 3 a.m. 3 a.m. thoughts that I mentioned is that, so basically the housing cycle or the housing growth in Canada is at a standstill, yet our shortage of housing continues to grow. And if you look at stats over the next 10 years, we need to build somewhere between 3 to 6 million homes, depending on how you look at it, just to keep up with demand, whether it's immigration, whether it's natural population growth. But yet today, everybody's gone pens down because it's very difficult to pencil residential development. So what's going to happen? Now, logic says, so pending any massive geopolitical event, logic says that interest rates are going to hold at this sort of mid twos as they sit today. We're going to start to maybe go through a recession cycle and then come out the other side. There's going to be a pent-up demand for housing, and there's going to be no housing supply because the majority of developers are not moving forward with their projects unless it's under complete necessity or it was in progress. So I think there's a real world in the next 3 to 5 years where we're going to come out and we're going to have a problem. We're not going to have a housing crisis. We're going to have a housing catastrophe, and it's going to be at all levels of affordability. And I just think that anybody that's able to continue to proceed with residential and take advantage of this time to build and not be looking for necessarily income or liquidity or other transactions are going to be in an excellent spot. And I probably say that because I'm in that position and I'm hoping that's the answer. But
well, you guys have a, I mean, your funnel is pretty big right now, correct? Like it's
yeah,
like,
so we actually have a pipeline of 25,000 residential units in Canada to be built. And it can be seniors housing, condo, rental, and student housing. So we go across all the asset classes.
But you don't do single family.
So we have one project in single family, but when I joined in 2019, we had this massive single family housing project. And coming from where I did, which was Minto, which is a very large single family housing developer, and then reflecting on our investment period. So we have short-term funds. We have what they're called closed-ended funds, and closed-ended funds are funds that have a lifetime that you kind of have to build it, finish it, and sell it. And if you don't do it within that period of time, the returns to your investors suffer, and you go outside of what was expected. Single family home projects don't fit in that short timeline. So I made that decision at that point. So let's burn through what we've done, but going forward, that just doesn't fit our investment philosophy of a shorter term cycle. But we do all basically all forms of high rise. And one of the things you asked me a little bit, like, what do you do when you're facing down this crisis? And I'd say about 2-3 years ago, my conservative accounting nature in me said, something doesn't feel good. Like, interest rates are starting to squeak up a little bit. There's noise in the market. I want a full lay of the land of everything we have in our pipeline and what's coming up in our pipeline. I want to understand interest sensitivities, like all the boring stuff, to know what the problems were within the portfolio. And having spent many years working in the apartment space, I knew there's a nice safe zone called building apartments, because when things are bad, people rent because they can't afford homes. When things are good, rent goes up. Like, you really can't go wrong with apartments. The challenge with apartments is that when condos are hot, apartments aren't attractive. But at that point, I was like, look, sorry, big old boring Jamie CPA is going to tell you we're going to reserve a bunch of capital, and we're going to look at all our residential high-rise projects, and we're going to decide how many we can make apartments. And so this year we'll break ground on 5 high-rise apartment projects.
And were those, so if you're breaking ground, they've been in the process, they've been in the funnel for what, 3-4 years?
Anywhere from 3 to 5 years.
Yeah.
Some of them were early entitlement, like we bought land and it was purposed for something else, and we changed it to ready to go in the ground a year ago. So it was a mix. And I would say probably 2 of them, at least, if not 3 of them, we bought them under the premise they would be condo buildings. But
that's what I was going to ask you. Were these going to be condos, and now you're flipping them to apartments?
Yeah, and I was like, I'm stubborn, and my team would this was one of the big solid debates. I remember 2 of them specifically. I was like, these are apartment sites. No, James, they're 20s as condos and they're 14s as apartments. And I'm like, well, 14 seems pretty attractive in today's market, doesn't it, my friends? A little I told you so moment. You have to have those sometimes, Dwayne. A little I told you so.
Yeah. So I'm curious, just like, I want to talk, I do want to talk about some of the stuff that's happening geopolitically and all that kind of stuff. But while we're on the topic about residential, we 18, I think roughly 18% of our listeners are like 24 and under, actually, which is pretty high, surprisingly. And thank you for all you people who are listening that are 24 and under. But we also have, obviously, a bunch of entrepreneurs here who have kids that are in the age group of, us or me, that are kind of the kids. They have kids that are looking to move into, and I get often asked, like, kids can't afford a house. Like, if we don't help them out, then, they're relying on us to help them buy their first home. Where do you think the market's going to go? Like, what do you think the opportunity is for kids? What advice would you give, or do you give to people? I'm curious on your insight.
Yeah, like there's a lot to unpack there. So one is, there is actually just a general trend towards rentals across the younger generations. The younger generations want to be transient. They want to spend their disposable income on travel. They don't want to be locked down necessarily into buying a home. So parking the ability to buy a home, that's actually just a real fact pattern. So, people are weighing, like, if I spend $1,000, $1,500 less by renting, I can invest that elsewhere, or I can do something else with that money that's more enjoyable. So we do see that. So we see a greater propensity for people to voluntarily rent. So again, that creates a greater demand in that space. But in terms of buying a home, you're right. Like, the accessibility to buying a home right now is massive. It's very, very difficult for the younger generation to be able to save up enough money. And if they don't have, parents like you or I that can help them, like, think about you and I, Dwayne, back like when we were starting out, we were in our most difficult times. The thought of being able to buy a house would be, you would basically park that into a suitcase and throw it out, because you wouldn't even try to get there. And so they're being very practical with that and saying, okay, well, how can I invest otherwise? That said, I do feel strongly real estate is always a good investment, because real estate's not a short-term asset. And people get caught up in, well, my condo's down in value right now, or my mortgage cost is up a little bit right now, or my values are down. Look, it's a 10, 20-year investment. So you can't, if you can't afford to go through those ups and downs in that 10 or 20 years, you can't afford to invest in real estate. But if you can, you will consistently thrive. People need to live places, people need to work places, people need to shop places. That's not going to change. Things around the periphery might change. AI might change how services are delivered, how leases are leased. But the fundamental thing that will never change for society is the fact that we need to exist in buildings. And I'll tell you a funny example. And I was asked to speak at a investing in real estate event, and it was young women. And I'm usually talking to more institutional investors, but this one was actually for a condo we were selling. And I went in and I was talking to these women, and one woman said to me, I really wish I had invested in real estate instead of my Chanel purse. And I was like, okay, wait a second. This whole time I thought I didn't own a Chanel purse because I was stupid, and you were able to do both. But you guys are actually deciding to invest in your Chanel purses instead of real estate. I was floored. I was floored that people were choosing to invest in consumable products instead of actually putting into real estate in a way that again, you can manage the ups and downs, but over time, at some point that mortgage is going to be paid off, and you're going to own $1 million or $1.5 million condo or home, and you have this liquidity available to you in your retirement.
Yeah, well, I mean, and I think that's part of what we've created in this society around what we value and what we don't, what we value and what we should value, what we don't value. You know, it's insane that you're right. Like a purse or a pair of shoes or something like that is going to come above owning a piece of real estate. And I also sometimes think and question, because we're in the senior care industry, you know, I see seniors all the time, and as you are too, where they're, you know, they're tapping out on their funds, you know, and there's still like, there's still a runway left of care required for, you know, both mom and dad. And then they're relying on their kids now to take care of them in their senior years. Not all, but there's many instances of that. And it's, you know, I don't know how we teach young kids to figure out what the long-term play is. You know, and I don't know if there's an answer to that, to be honest with you.
There's such little financial literacy in all levels, all ages. It shocks me. And I did not appreciate how much I studied it, and how much, you know, I've just grown up in my career and studied it academically, and then built my own fundamental principles and my safety net and all the right things. I didn't appreciate how many people actually don't take the time to understand true financial literacy. And part of financial literacy is making difficult decisions. And these women that had bought the Chanel purses, like, they didn't do something wrong, but they just didn't know any better. Like, they're like, I've got $5,000, I buy a purse. And I'm like, no, $5,000. You put it into a savings account, then you do that 2 or 3 more times until you have enough, and then you invest in something that's going to pay you off long term. Pay yourself first.
God, if you put $5,000 away in 2020 in a TFSA and just invested it in like a Vanguard fund or whatever, like you'd probably triple your money in like the last 5 years with the way the stock market has gone. Probably more than that. I haven't looked at, like, I haven't done that calculation, but it's insane. You know, spending. I mean, but this is what you have to get good at if you want to be successful in business, is how you spend money, how you budget yourself, how you, like, what your priorities are in spending, and where do you allocate your resources in order to get the most return on your investment. You know, it's crazy. I worry a lot about kids, but I also think, you know, when they say, well, I can't buy my first home, it's like, are you being resourceful enough? Because when I bought my first home, I had 6 roommates. I turned a 4-bedroom house into a 7-bedroom house, and I rented out to students because I was close to a college. And I had at the time I think I had a $45,000 a year job. Now in fairness, houses were not $1 million. I think I bought my first house for like 300 or 350,000 bucks. But I mean, I was making a lot of money. I could have just rented out and, you know what I mean, gotten by. I think I've never run the numbers on a house yet because my kids aren't at that level yet. But, there are some sacrifices that need to be made around that.
That's the thing, right? Is financial, like making the right financial decisions are not fun. And, I think you hear stories about crypto and you hear about like these quick wins and Nvidia, et cetera. And people are thinking, well, I'm going to put all my money into one thing and I'm going to double it in 90 days. And that, like, they hear these snippets, but the reality is true financial discipline is painful. And to your point, you buy your first house, you have 6 roommates, or maybe you're not going on vacation for a couple of years, but then you grow into that house financially. And now you have the house and now you can start to go on vacations. And I've done that multiple times through my career where I really stretched for that house. And I pissed and moaned about it for a year. And all of a sudden the payments became easier and I had a little bit more money because I started making a bit more money. But my first house was $266,000.
266. Yeah. See, but when kids listen to us now and they're like, well, fuck, like, you were making 50 grand or whatever you were making. So we're maybe making 70, but we're paying 3 or 4 times for our houses. So there is a legit, I'm not saying that their complaints are not legitimate. I'm just curious on where does the government step in? How do we start to create and because you're in this industry, what do you see coming forward that might be able to help? And is there any, because of what you're saying, like housing shortage, like the housing starts are at all-time lows, correct?
Yeah, that's right. Yeah, like if it differs by city. Like the condo market in Toronto is completely collapsed. It hasn't been like this since the early 90s, and that's crazy. Like if you think about it, if you have a condo project or you have a piece of land that you plan to do condo on, you're not launching a condo for the next 18 to 24 months. And the last time I said that, my team gave me heck, but it's true. Like nobody's buying a condo. We have 30,000 units of backlog that's going to have to go through the system, and nobody's buying anything. Housing sales are down, anywhere from 75 to 80%, depending on the stat you're looking at. So it's a completely frozen market. But you're right. Like being able to buy a home right now it's $1 million investment. And so it is very difficult and it's very unattainable. So you flip yourself to, there's one thing about not being able to access the investment of housing, but what about just being able to access shelter? And that's where I get passionate. And again, it comes from my experience being young, is that I remember what it was like for my parents trying to find a home that they could afford on social housing or social assistance, and me coming out of school and needing to live in Toronto, but not making enough money and having a ton of debt. Like, where am I going to live? And like you, I lived with a bunch of roommates at different points in time. But so if you look at the different federal platforms, there's a lot of discussion around housing, but you sort of need to break housing into a bunch of categories. The first is social housing. So social housing, I believe right now we have 600,000 social housing units in Canada. That hasn't changed in 20 years. Well, ignore all the discussion about being able to buy $1 million home or 10% below average rent to create an affordable unit. Social housing is the most basic need for housing in Canada. The government needs to invest in social housing. That is an infrastructure investment, and it hasn't been made. So that needs to be prioritized. And what sits around social housing then becomes special needs housing. It could be, children or adult children that have special medical needs. It could be very, very low income seniors. Like that piece of the housing market hasn't been touched in decades and needs to be addressed immediately, because those are the people that are in most desperate need for shelter.
So how does this get solved in the future? Like it looks pretty glim from this, from just this short conversation about it, where, you talk about the housing. We could be like, we're in a housing crisis today, but it could be a catastrophe in 2, 3, 4 years. And I mean, obviously my assumption is, or my hallucination is that on the special needs housing and the social assistant housing, there needs to be some government intervention and to spur on that kind of development. Is that And that, am I correct?
Yeah, so I kind of look at it in three buckets. One is that social housing, and so that needs its own attention. It needs funding. It needs a program behind it. It needs to be treated no differently than building a subway system or a hospital. Is there needs to be attention to social housing to deal with the greatest need for people that are in a situation that they can't, ignoring buying a home, renting an apartment. Then you start to talk about affordability, and affordability really, you got to start with rentals. And the challenge we face is so many levels to it. So about 18 months ago, I want to say, is the federal government made the decision to remove HST on building rental housing. That was a huge help. Like that takes upwards of 10% of the cost out. And
Was that a removal or a deferral?
it was a removal, and there was a lot of question as to whether it was going to be just a deferral. It was, but it's a removal, and most of the provinces followed suit. So it wasn't just the GST portion; it was both the provincial, and that was a huge help and started to make things more affordable to build. The second thing is just getting approvals, and the cost of municipal costs, like development charges, for example, are massive. So to give you an example, to build one unit in a high-rise building in Toronto, you're paying $135,000 per unit before you've even put a shovel in the ground. And that's ignoring the delays that you're facing getting things through municipal approvals. Further to that, municipal approval process is changed by every single city, every single province. And so there's no consistency. Like, you don't know what you're going to pull up to the drive-through window of municipal approvals. How long is it going to take me to get there? And I'm spending $135,000 a unit before I've even started my project. So that's something, and that's been very prominent in both of the lead federal parties' platforms, is work around reducing municipal timelines, and reducing development charges and municipal charges, or at least deferring.
So the reality is, though, how do they influence that at the federal level if it's a municipal decision? And like, I don't understand how that correlates. Or is it a bunch of bullshit? Like, I mean, I can say that, you can't probably.
I know.
So don't agree with me on that.
I do not comment.
But I'm curious.
I think, I mean, the way to do it, because the reality is the cities use that development. They should be using the development charge money to actually be building out the services required for us to build buildings, right? So you need more sewers and more water. So the question becomes, like, if the municipality actually needs that money, it becomes a refund from the province and from the feds, right? So they've actually got to give money to flow it down through the transfer system to the cities to be able to make it happen. What concerns me is that you see these platforms of the federal party saying we're going to do that. Well, the election's April 28th, and then they got to get back to the House, and then, like, all of a sudden 18 months has gone by and money's not flowing and buildings are not getting built, and every year is a problem. So the other piece that's very helpful, and has made a big difference in our projects, has been different types of CMHC funding. So, for listeners, especially if you're not in Canada, CMHC is I guess I was going to say it's like the Freddie Mercury funding. It's like Fannie Mae.
The Fannie Mae? The Freddie Mac?
Yeah, exactly. It's like it's insured mortgages, and when you're building high rises, they have different programs if you can achieve certain levels of affordable units, environmental, like geothermal there's a scoring system, and it's a lower cost of debt and a higher amount of leverage, which means you need less equity to be able to build buildings, and then you also deliver affordable units. So all those pieces coming together are helpful, but the last piece is we're all over the map across our country on regulations, like rental regulations and municipal regulations, and work to create consistency on how do you access funding to build affordable units? How do you access CMHC funding? How do you charge rent? What are the rules around rent? Like, work to create consistency so investors know what to expect every single time they want to put a dollar into the housing industry.
You mentioned that the condo market has collapsed. So I would love some perspective on that, a little bit more perspective on that, because when I hear that, I go, oh, well, why don't kids invest in condos? Because if the market's collapsed, they must be cheaper. This total assumption, and if they're cheaper, and then we're going to be heading into a catastrophe in the next few years, when you want to buy a condo now, and then in 4 or 5 years see that grow in value, or am I wrong on that?
No, you're right.
I'm totally open for you to tell me that I'm an idiot,
Yeah,
because when you said
I will.
earlier, I know you will, but when you said earlier, you're like, yeah, sometimes I have imposter syndrome. I'm like, think about me sitting in this chair. Like, I'm a college dropout. Like, this is not the shiniest bulb on the tree. Like,
You're
so
so hard on
I
yourself.
stay within the conversation. But it's one of those things where it's like, I, I don't, how do you shed light onto this? Like, please shed light onto where the opportunity is for just the, even the, for the first time home buyer, where's the best opportunity? And then, because, I've read an article that Warren Buffett said at one time that he felt, and don't quote me on this, but that, that, uh, that buying a home is the worst investment that you can make unless you use it as a forced savings program. But if you are a disciplined investor and you're disciplined at saving money and you're disciplined at putting it at the market, that the market will rise faster than real estate, and that, and you're not reinvesting, because everybody buys a house and goes, oh, we got to do the backyard. Oh, we got to put a pool in. Oh, we got to do the kitchen. But when you rent, you don't do that stuff. So that you don't have those big capital investments every 2 or 3 years where you're dropping 10, 20 grand into your home. And so his thought process was, invest that in the markets, invest that in a business, invest that in yourself, and you'll get a better return longer term. I'm not saying but that was an article I read, and that was a long time ago, so I could be misconstruing the article a little bit. So sorry, Warren, if you're listening, if I misquoted you. No, I'm kidding. But where's the opportunity for people? And then where's the opportunity for people who own their own business, who are looking to invest outside of their businesses, into real estate, because that's a very popular investment for people. And I'm just curious on your perspective.
Well, I'm glad Warren doesn't talk to any of my investors, first of all. Jesus. You don't give yourself enough credit, Dwayne. Like, just going back to your point about, I take notes when you talk. Like, I write down, like, yeah, I gotta have vision. Like, you gotta give yourself credit. Just because you don't go to formal education doesn't mean that you're not rocking this world and making all of us that spent way too much money in university feeling quite humbled by you. So give yourself some credit. But
Well, thank you for that.
Here's what I get what Warren Buffett's point is, right? Which is, if like all your money that you have available to invest is going into a house, and you have no more money to invest in any other place, there's a question mark, right? Because now you have no diversification of your portfolio. I think that's what his point is that so I get that. So let's park that aside. What I do want to do is talk a little bit about the condo market. So there were a bunch of things that were nails in the coffin. I don't want to use coffin because it's not a permanent situation, but in Canada, in most big cities, when condos are built, 50 to 70% of the condos in those buildings are bought by investors. And those investors then take those units and they rent them out. But a few things happened. One is there was a change in the capital gains inclusion rate, which has since been backed off, but at the time it was. So that means that at one point in time, only 50% of the income you earned when you sold an asset got included and taxed. The Liberals a year and a half ago announced that they're going to change that to 75%. Well, that hits real estate hard. Like I said, they've backed off on that. Second thing is interest rates more than doubled, almost tripled in some cases, depending on what your starting point was. So the carrying costs of those condos for the investors went up so high that they couldn't rent it out enough to cover their costs. And you really, like, when you buy a condo to rent out, you are just trying to cover your costs, because you're just like basically parking it and letting it rent. And over time, the mortgage gets paid down, and now you have this asset that's available to you. So the investor market completely dried up. And so 50 to 70% of buyers disappeared. In addition to that, as interest rates were going up, everybody else who was buying was like, I can't afford a mortgage. And there was the collapse of the condo market. But it leads to the second part of your question, is what's the opportunity? Now's the opportunity, because what I'm seeing happening in the market is that you have these condo buildings where, 80% of it's sold, 20% of the inventory is left. And smart money is buying up units right now because they can buy it at 20, 30, 40% below what it was selling for a number of years ago. And they're renting it because interest rates have come down. The capital gains tax has been pedaled back. And these are good deals. And they know that they're back in the market. So I've seen this a dozen times in like the Toronto, Hamilton, etc. area because these developers are desperate to unload and get the cash out of those last units. And this smart money is quietly going around buying up these units. So I would say now's a great time to be buying up the excess inventory because there's not much coming on in the next little while. We see, like, you're almost going to see something similar in the office space. So office has had a real struggle because of COVID. People aren't coming back to work, or they weren't coming back to work in the office, and that's changing. But in that disruption, people stopped building office. And so there's no real office supply coming on anywhere in the major Canadian cities in the next 5 to 8 years. So office is then going to become a product that although the demand has gone down, like globally gone down because of return to office, it's coming back and there's no change in the supply. So that's just kind of the fundamental underlying principles of real estate, is that if you can survive the cycle, it will always, at the end of the day, be a good investment. And then if you think about a business owner, like I would have a hard time as a business owner not owning the asset that I was operating within, because I just know the value of underlying assets. Industrial, for example, if you're manufacturing, warehousing, etc., industrial right now is a great place to buy because the values are dropping. That came when COVID happened. Everybody wanted to onshore. Everybody started to build industrial. Rents more than doubled over that period of time, and it became the hottest asset class. But now it's being disrupted because of the rhetoric in the US. Nobody wants to sign a lease. And so leasing has slowed down. Vacancy has gone from like 0.9% to like 4.5%, which is not a crazy number. So if you can get into the industrial space right now, over time, it's going to be a great investment because we're going to come out the other side of this supply glut. I'd say one of the hottest asset classes right now is seniors housing. So we talked a little bit about that, Dwayne, is it's very difficult to pencil building new seniors housing, but the aging demographics of North America are continue to roar on, and the need for the housing is continuing to grow. So again, disconnect between supply and demand fundamentals. And then data centers. Everybody's hot on data centers because of AI. And the challenge with data centers is now getting the power to the data centers, keeping the data centers cool, and then obviously providing the power to the underlying technology.
If you're a business owner and you're investing money, where would you invest it? If it was you, what do you see? And because that question depends on what your time frame of return is, and like, what are you looking 20 years out, or are you only looking at 5 years? So if we were looking at 5 years and I want to park my money in a place where I think I'm going to get the best return, where do you feel at this point in time? And I'm going to say this first, guys, this is a conversation. You're not taking investment advice from this conversation without doing your own research, but we're just having a conversation about where we would park our money over the course of the next 5 years based on what we see happening with tariffs and onshoring and all the things that are happening. Where would be the likely best place that you would park your 5-year money?
Yeah, I mean, you're right. It depends on your investment objectives. Like, do you want cash out of it? Do you want to just generate return? There's a lot of different things. And actually, that's what I love about real estate, because people will say to me, what do you think about the real estate market? I'm like, how long is a piece of string? Because every part of the real estate market behaves a little bit differently. So, so I'm going to give you an Easter basket of answers. So
I love it.
I would definitely be looking for discounted condos, like a good builder that's trying to unload, 10, 12 units, maybe 20 units, that are just discounting things for 20. And I would buy those at a discount and, put debt on it and start to figure out the rental market. But I would want to be in a position that I can actually hold those without rental income for a couple of years. And that goes back to kind of earlier in the conversation, my whole philosophy, always have a contingency plan. So I'd want to be able to afford those units on my balance sheet for a period of time without income. knowing that longer term, I've now bought it substantially below what it's going to market at in 2 or 3 years when the market starts to normalize. The other thing I would definitely, if I had the money, I'd invest in apartment developments. Apartments are like, they're counter-cyclical, and they're counter-cyclical in the sense that they always do well in a recessionary period because people rent. But even in a period of boom, well, now you get the benefit of the rent increases and, like more people moving into the city, more people wanting to live in it. So the reason I love apartments is that they don't blow you out of the water like a big condo investment, but they're just like, they're nice vanilla pudding, right? People need them. Don't go high test, nice meaty middle, basic apartments, boring as anything, but people always need them. And then like, I could nerd out on apartments for a
Yeah.
little while.
Well, but that, why not? Why don't we? Because I think you raise a good point, and I've jumped into some development projects with a partner of mine, over the years, and right now he's looking at building an apartment building, not like massive apartment building, but I don't even know how many units it is to reference it. But anyways, but we've talked about this, and apartments are interesting because, and I want to say this too, guys, for the listeners. It's like, Jamie just said, well, go out and buy like 10 or 15 or 20 of these condos, like, and some people may listen to this and go, well, I can't afford 10 condos, but you could buy one, or you could get into a diversification model where you go out and say, hey guys, go to a bunch of your friends, reach out to your network and say, hey, let's research this. Does this make sense? This might be a place where we might want to park our money, and then, form a partnership or whatever it looks like, and put some money in, get some debt financing, and take a different strategy and look outside the box. So I just wanted to throw that out there for people who don't see that as an opportunity. But then the apartment buildings, like, maybe you could talk about like cap rates and stuff like that and how that applies, because I find it really interesting. Like when times are good, rents go up, and so it affects your market cap, and then also the value of the land and the building also go up, of the apartment, and so it really does help your market cap rate. So you can refinance based on a better market cap. You can sell it based and take a win if you want, if you have other places to park your money. So, but this stuff way better than I do. Like I'm like super basic on this, but it's not where we put our money. I don't, but please share whatever you've got.
I'm glad that was a good call out on the condo units. For the record, I'm not buying 8 and 10 chunks of condos myself. I'm always looking at things from an institutional lens, right? Like I'm investing on behalf of institutions. But
Yeah.
yes, I love what you said, which is like, 4 or 5 of you get together and buy a condo and just like park your money there. Just ignore it, put it away, and then you are going to benefit. And if the market starts to come back, and you can rent it. But so like fundamental apartments are actually one of the easiest assets in real estate to value, because you do what's called the direct capitalization method, which is just a fancy way of saying whatever your income you make on your condo, or on your rental, you multiply that based on a cap rate. So if a cap rate is 4%, that's the equivalent of being a 25 times multiple. It's like you flip the fraction over. So if you're making $10 million of income, it's a 4% cap rate. You multiply that by 25, it's $250 million. I think I did my math right there. So, that's how you value apartments, to your point, Dwayne. So there's a bunch of things that can happen now. Is your rents continue to go up every year. If you are built after 2018, you can increase your rent as much as you want when leases, either somebody moves out and a new person moves in, or just the in-place lease, you can increase it on an annual basis. And so every dollar more you get in rent, you're gaining 25 times that in value. And so, and they don't, rents and costs don't act in line with each other. Like in other industries where your revenues and your COGS behave together, rent and costs don't in apartments, because your costs are things like property taxes, utilities, people, and like repairs and maintenance and so on. So a lot of that just behaves based on what the needs of the building are, or what property taxes are going up. And so like really your focus when you're in a building is how do you drive revenue? And then as your market improves, your cap rates change. So cap rates are a calculation of a combination of things like cost of debt, so mortgage costs, what the risk is within the market. So your cap rate or that multiple changes depending on what city you're in, where you are in the city. So in Toronto, if I have a downtown apartment, I might have a 4 cap rate, which is a 25 times multiple. But I go a bit north, it might be 4.5, and then you're into 20 times multiple. So and it's not hard to figure out what that is. You can buy research online to know what your cap rates are. It doesn't mean the 4 cap is a better deal than your 4.5 cap, because chances are it's riskier downtown, right? You have higher rent, you might have more turnover. Like but there is probably more value in being able to afford to buy more downtown than midtown. So there's all kinds of really cool things that you spend and you research and you learn about. But then the other thing is as the market gets better, all those cap rates start to go down and your multiples get higher. And that's what happened in the apartment space in, starting sort of 2010, 2008, 2010. Cap rates, we call it compression. Cap rates started to go down, multiples started to go up, and it got really hot. And you would hear actually examples especially in Vancouver, where the apartment market's very tight. There'd be like 2% cap rates, 1.5% cap rates, like 50 times on income. And we're all looking at each other like, that cannot be sustainable.
That's not the time to buy.
That's not the time to buy. The time to buy is now, or invest now, when you've got cap rates of 4.5% and 5%, right? And even that's low based on history, but it's a little bit more sustainable because you've got really predictable demand and you've got affordable debt. But what I'm actually fascinated about in all aspects of real estate, and particularly apartments, is how it's going to be disrupted by technology. Apartments are people-heavy businesses. You've got somebody mopping the halls and fixing toilets and taking leasing orders at the front desk, and there's a lot of old product out there. Like the vast majority of the apartment space are built in the 60s and 70s, and they don't have tech within them. And so I'm really interested to see how the property management space gets disrupted and whether that drives value through the top line by being able to provide better services and better tenant experience, especially in the newer builds.
So actually that leads right into a question that was popping into my head as you were talking, which was, as an investment vehicle, or a growth strategy, how do you buy a 6 or an 8 cap building and turn it into a 4 or 6 cap building, or you know what I mean? Like,
yeah,
what would be the techniques? What would be the things that that you guys would look at, or the industry is looking at, to be able to say, hey, where are the opportunities here where I can find something, and then spoof it up, I guess is the word. For lack of a better term, spiff it up.
Spiff it is up. The technical.
Spiff is the technical word. Sorry.
Yeah.
So spiff it up, but also, like, and it's interesting. You talk about AI. Like, how do we use some of the technology that is available?
Yeah, and so the spiffing up. So at Fengate, our philosophy is to build new. And the reason we do that is, and I'm not going to say either strategy is wrong. Both strategies are right. You just choose a lane. And so the lane I chose and it doesn't just apply to apartments, it applies to retail, applies to industrial, is to build new. And the reason I want to build new is I don't want to deal with the capital risk associated with things like balconies and falling down windows and parking garages and that kind of thing. So instead I said, like, it's a little bit more expensive to build new. Your upside is a little bit more muted once it's built, but you also don't have the risk of the capital and you have solid income growth. So that's one philosophy, and again, applies to all the asset classes. In my previous role at Minto, we actually had what you were describing, which is more of a renovation strategy. So we built new, but we also bought old apartment buildings, those 1960s and 1970s. And so say you buy it for a 4 cap or this 25 multiple, but then you would go in and you had all these people living there well below market rents. So they'd be paying $500, $1,000 a month below market rents. And when they'd move out, you'd go and you'd fix up the kitchen and you'd put some paint on it, you'd invest some capital. And so say you invested $30,000 of capital, but you increase the rent $1,000 a month. Well, that starts to increase the value of the building far, like, exponentially versus the cost you're investing in it. And so now what you've paid for that building versus what that building's worth is a much, like, it's a much lower multiple. So I mean, I'd love to pull up my spreadsheet and share my screen and show how all the inputs and outputs work. It's not
Yeah.
complicated, but there's a lot of pieces to it.
Sure.
But that's the principle, is that your 4 cap that you bought the building for is now, when you're done your renovation or you've moved a bunch of renovations through, is now a 5 or 6 cap because it's built in value. But what's really interesting, Dwayne, that happened in, like, the mid-teens was, you used to be able to rely on about 25% of people moving out every single year. So you go in, you'd spiff up those 25% of the units, and you'd increase your value. And over 3 or 4 years, you've done most of the building. All of a sudden, rents were going through the roof. People understood that they were getting a good deal, and people stopped moving out, and your
Right.
turnover dropped to 8%. And I remember being caught in that exact example. It happened so fast, is that all of a sudden my business plan fell apart because people weren't moving, and I couldn't access those units to renovate them and drive the rent.
So instead of a 4-year renovation cycle, you flipped into a 12-year renovation cycle.
Exactly.
Huh,
And rent and, like, landlord and tenant relation or laws are very strict. So I can't force people out. And you do hear that in the news, right? You hear about rent evictions, and some of it is justified. Some people did very untoward things, but more and more institutions are getting afraid of that strategy because they don't want the headline risk of being the big bad landlord that kick people out to renovate.
Yeah. What do you think? What do you think's going to happen with tariffs? And do you guys have any, like, insight on what that might do to the industrial and wholesale warehousing? Sorry, not wholesale, warehousing real estate market.
Yeah, well, I'll give you kind of Jamie's view, which, could be completely off because we are in unprecedented times. So when tariffs first announced across all forms of real estate, everybody was like, I'm not doing anything because I don't know what's going to happen, right? And, is it going to cause inflation? Is it going to cause exchange rate risk? So we were worried about depreciation of the Canadian dollar. We were worried of inflation. And what we saw was any kind of U.S. group that was looking to sign tenancies in our industrial space literally called us and said, we can't move forward. And we continue to face that. And it's loosening up now. Like, the rhetoric in the U.S., most recently, they're backing off all the talk around China. The tariff talk as it impacts Canadian goods is a little bit more focused. And so there's a little bit more confidence coming back in the market. But what I'm beginning to wonder is whether or not something similar that happened in COVID, which was Canadians got nervous and said, like, I can't get goods over. We can't even produce vaccines in Canada. We have to import them. And that's what drove the abundance of supply and the abundance of breaking ground in industrial, is because we wanted supply chain certainty in Canada. Well, why wouldn't we? Everybody's worried about all these companies that are across North America leaving Canada and going into the US to avoid tariffs. But why wouldn't we see something similar happen, that people want to root in Canada and be able to create a greater security in our supply chain in Canada with our own natural resources, steel, lumber, etc., so that we become a little bit more reliant on our own economy and need access to industrial facilities to make that happen?
Well, and I guess, does that just not depend on, like, what moves out and then how much of a gap that leaves? It, yeah, we're in such uncertain times, eh? Like, sometimes I feel like, with the way things are going, this could be a nothing burger in 6 months, and everything kind of settles into some bit of normalcy. And so, how do you make decisions at this level with your teams to know where to be, and then to where to to invest your capital? And I think this extends into and because the reason why I asked this question is because I think it not only just is not about Fengate, but it's how do people right now who are listening to this podcast, who are in manufacturing, who are in warehousing, who are in different areas where tariffs are going to affect them, building supplies, what happens with that, steel. So I'm curious how you guys evaluate that investment model.
I would say for the first time in decades, I'm seeing construction costs actually come down.
Hmm.
And that's, I mean, that's great for me who's building real estate. But it's not obviously great for manufacturers and trades because, and that's not just tariffs. That's a function of just the general slowdown in the market and the need to fill up with it from a business standpoint. You know, I'm a bit like you, Dwayne. I kind of wonder if this is going to turn into a nothing burger. I think, you know, anything's a shock initially. It was a shock in February. Um, and then, you know, Trump came out with his cardboard breakdown of the great deals he was giving some of the countries on their tariffs. And like, it's all been like a little bit of drama, but we all adapt, right? Once we understand the facts. And so the disruption right now is just uncertainty. And now that countries are starting to engage with the US and they're starting to understand what the real landscape of tariffs are, in 3 to 6 months, everybody will know what they're dealing with and it can adjust their processes and where they're located accordingly. And we all adapt. And to your point, like I would not be making big speculative calls right now. I would not be, you know, I would not be necessarily throwing a bunch of money into crypto because we think this is going to be like the new gold. Uh, Although a lot of people are putting money into gold right now because it's uncertain times, I would just stick to fundamental investing principles. Like we have a housing crisis, so we invest in residential. We are going to continue to grow and need a supply chain enabler within Canada. Industrial makes sense. AI is going to continue to drive data needs. Data centers make any sense. Like, and I'm using real estate examples only because that's what I'm close to. But if you look at any industry, you just have to stick to your fundamental principles because those will hold and stay in that narrow corridor of investing and still until things start to stabilize.
It's great advice. It's great
It's
advice.
boring.
We've had, but boring is. I mean, I know a lot of guys who and girls, women and men who own businesses that are unbelievably boring, and they just have this constant return over and over and over again, and it's just like, oh my god, that's so smart.
Oh yeah,
And
look, I
you know,
know.
boring is like, yeah, I don't, excitement is yeah, I once owned a record label and it was exciting and it was so much fun and I lost a lot of money.
Like
So
I've worked on some pretty distressed situations, and I won't get into them specifically, but I will take boring every day of the week. Like it's just the problem is when you run into these like exciting, like you just don't know. There's no predictability. You don't know how to make decisions. You're just flying by the seat of your pants and hoping luck works for you, or you're making a lot of people angry.
yeah, I think it's funny. Like when I look at what's happening, especially in North America, and the conversations about sovereignty and the tariffs and all that kind of stuff, and it's like I think when we look at this in whatever 5 years and looking back on it in hindsight, I think one of the things that will be a bit of a blessing is that we have become complacent. This is the risk. It doesn't matter where you're from. It doesn't matter where in the world you're from. Complacency kills. And when things get comfortable for too long, you become complacent. That's human nature. You had talked about it earlier on the podcast. And I think one of the blessings that will have come from this is that it makes us stand up and take notice and evaluate our strategies that we've used in the past. Necessity is the mother of all invention. So, people are getting a little bit desperate. They're getting a little bit tight there, and that's going to change their thinking, and they're going to start to look at other opportunities and to see where they can focus their business in other areas, whether that's other countries, other distribution, other products, other services. And I think in the end, maybe I'm just being the eternal optimist, which I like. That's the side of the fence I like to sit on. Is just I think that everything that we're facing right now is here for a reason, and just to check us up. And at least that's what I hope. And that's kind of what I'm banking on. But
I kind of, I feel the same way, Dwayne. I mean, God forbid we end up in war, like global war. And again, Carl talked about it a little bit on the previous podcast, is that, there's some fundamental things going on in the world right now that point to mass war. And let's all pray that's not the direction we're taking. And everything we're dealing with is, trade wars and economic discourse and all things that we can kind of work through if we stay disciplined. But I do believe through the pandemic, there was a certain malaise that went into society. And you saw the productivity on a per capita basis in Canada continue to go down and went down for 10 years. And you saw people, and now people talk about this 51st state, and there's sort of these whispers like maybe that wouldn't be so bad because of our productivity. Well, now what we're starting to see is a true patriotism in the Canadian system to say, wait a second. First of all, 51st state, to get to 51st state is going to be 10 years of civil war. Like, let's be realistic. It's not going to be a bill that gets signed and all of a sudden we have access to a lower tax system.
It's not going to be a party, that's for sure.
It's not going to be a party because
No.
even if like 10% or 15% people agree with that, 85% of Canadians are truly proud and will fight for our patriotism. So what does that mean is we've got to lean into being Canadian and we got to get back the productivity. We have the greatest natural resources in the world, or maybe competing with like a country like Russia, maybe, but we have this natural resource system. How are we going to exploit that and take our position as a true economic world power again?
Yeah. I love your comment about the productivity slipping in the last 10 years in Canada. And I think that, to the complacency and the listener needs to share, like, this is really, to me, really, really important, is how do we think as a society that we can become the lowest productive nation in the G7 or G20, I think it is even, that, and still sustain our way of living in the future. Like, it's not possible. I mean, people need to wake up to the understanding and the realization that, where we positioned ourselves over the last decade cannot be where we can be in the next decade. We have got to drive productivity. It's the only way for a country like Canada to maintain where it is, or we will see healthcare collapse, education collapse. Like, it's just, you can't sustain it. And or we will print more and more and more money and then become, a Venezuela or whatever. I mean, that would be drastic, but we will just continue to devalue ourself, our position, and our dollar in the world economy. It's just, we just got to get down and start working yeah.
Yeah, exactly. And it's painful.
And I do think, like, and again, I guess I'm being an optimist and I'm not being I'm not being on the Trump bandwagon, but there's a realization that has been brought forth in a lot of areas that we need to take a look at where we are and where we've brought ourselves over the last several years. So
I agree. And
anything, sorry, go ahead.
No, I was going to say it's interesting because when I think about the productivity dilemma in Canada, there's so many elements to it, right? Like, there's so many pieces contributing to it. There's no silver bullet. And then people just look to the US and go, well, it's just better down there. And so we have this brain drain going down to the US in all disciplines. And, even myself, it's like, maybe I should go down there, pay a little bit more tax, pay less taxes. But as a true red and white patriotic Canadian that wants to see this economy turn around, like, we've got to have a serious conversation about the 50 contributors that are putting us in this position and stop just kind of turning a blind. I think too many people turn a blind eye to it, that how serious this problem is.
Yeah. And listen, I can't, like, as you bring that topic up, like, I can't, and I would be, if I didn't address it, I wouldn't be congruent. I mean, we're one of those people, like, we just bought a company in the US and we're down here now and we're getting it up and loaded. And I think that's partly, it's not like we're abandoning Canada necessarily. It's just that we're hedging our risk. I mean, I just came off of, both my parents passed away. My dad passed away just over a year ago. When I saw the healthcare, I was like, man, like, I think I need some access to it, because I looked at Tennille and I said, hey, what do you think the odds are that our healthcare system will be better or worse in 20 years? And I mean, I could ask 10 out of 10 people and 9 of them will probably say 8 or 9 of them will probably say, I'd have to bet on it being worse.
Oh, absolutely.
Unless this ship turns and then this is our call to action. So
No,
I
I
do
agree.
want I wanted to ask you one question about, because real estate is a pretty massive percentage of the Canadian economy. I don't know what it is. Do you, off the top of your head, or?
I would be guessing as a
Yeah, okay.
percentage.
Yeah, because I mean, I think it's, my point to it is that it's going to be critical for us to turn this real estate, catastrophe, if you will, this housing catastrophe around, because that's what's going to have to be part of the economic engine. We can't have, all these people that are in this industry and the multiple layers to support that industry, not working,
That's right.
it's just gonna plummet us into a recession. So
Well, and one of the things we need to talk about that's interesting is actually the labor market, the trade market that supports the building of real estate, not just real estate, infrastructure, anything, right? And like, even if we turn on the economic engine of real estate coming back and infrastructure investment coming back, we don't have the labor to be able to deliver. And so there's a big question mark about, with immigration muted, and the lack of investment in driving trades and training trades and advancing the number of trades that we have in Canada. You solve the productivity engine from a housing standpoint, you can't execute on it. And again, that goes back to the layers and layers and layers, is that we need to look at all components, and real estate. Real estate's a huge one. Like, we typically, on an annual basis, you're doing anywhere to $40 to $60 billion of transactions within the Canadian space.
it is a massive, like, when you look at it, I mean, we need to get to work. And I mean, by the time this airs, the election will have happened, but it'll be interesting to see what happens with this election and then going forward. I'm curious,
Yeah.
do you feel like we need a majority government either way it goes?
Yeah, I do. I think
in order to get something done.
Yeah, absolutely. Especially with the strength of the two parties, the Conservatives and the Liberals. Like, they are so focused on not being collaborative and being different from each other, that if we and the NDP vote, for all intents and purposes, appears to have dissipated, it is going to be those two parties in the House.
Mm-hmm.
It is going to be a constant stalemate, and that's just not going to go anywhere. And the most likely example of minority will be the Liberals, with the NDP just kind of shaving off the majority territory. So regardless of what side, and I'm like you, I'm not going to say which way I vote, but I do encourage people to really study it. There's a lot of good information. This is the first federal election in a long time, where I've seen some good materials out in different like news pages that actually break down the different categories of their platforms and what they're saying, and really read and understand and get out and vote this time.
Yeah, that's going to be critical, getting people out and vote. And I think, to post-election, I hope we have a situation, whichever way it goes, I hope we have a situation where we can start to see some collaboration between the parties, and less politicking, and and trying to get things done, because there's some daunting things that need to be accomplished over the next 4 or 5 years.
Yeah, absolutely.
In the country, for sure. I can't thank you enough for being on the podcast.
Oh, thanks.
Your time. You've been so generous. I don't even know. I think we're at 3 hours here.
Oh, yeah, I just looked. I was like, I could keep
going.
Going.
Conversation. I know. I could talk to you all day, and so it's been an amazing podcast. It's been an amazing conversation. I know I can see already right now this is going to get split into 2 pieces. Like, we literally had 2 separate, powerful conversations about important topics, and your vulnerability has been unbelievable, and I can't thank you enough for sharing that. You always know I'm always available. If there's anything you ever need, you just always ring. And I loved it. I'll say this, it was amazing, and I'll thank you for this. Like, when I was like, I got to get Jamie on the podcast, and I think I text you, I WhatsApped you, and I think you were on holidays or something or whatever. And I was like, I was sending the note out, and I'm like, she's going to get back to me. Like, I guarantee you, watch this. Like, I'm going to hear from her like instantly. And like, literally, like, you were just right on it. Like, you're so on it. And you're such a role model. Thank you. Thank you very much for everything you're doing and the time you're spending with, Trent University and giving back and all the things you're doing. You're a class act, Jaime.
Oh, thank you, Dwayne. And it took me a long time to share my story and when what I do, the reason I do it is I want people out there to shed any feeling of shame because they didn't come from, a story of wealth or privilege, and that's okay. Like, it's okay. We all had our own moments and we may have been embarrassed, and as we get older, you start to realize that's just another square in the quilt of your life, and it's still hard for me to talk about it, but I really hope that people take away from this conversation that you should be proud of the challenges that you've overcome. But I thank you. And I'm so happy that we've met and we've built this friendship and I think some of our mutual friends will listen to this and enjoy some of the stories in it.
Yeah, I do too. And I think I just also want to add one thing to that last piece because I thought it was amazing. And the piece, especially about like, this is just one square in the quilt of your life. That is such an amazing quote. I've never heard it before. And I don't know if that's just yours, but it's cool.
Made it up.
Did you? Good. Well, I love it. But I also think too, like, there's a level of gratitude for the roadblocks you're going to face too, for the listeners and all of us. You are too. I will too. Like, there's more to come. I think sometimes the older you get, the harder it gets, to be honest with you. I hate to say it,
yeah.
but I do think like, I also said like, and this is just because I gave a talk yesterday, but it's like the goal is not to not have problems. The goal is to increase the quality of your problems, not to eliminate them, guys, and then face them with courage. And that's what I think, Jaime, you've done your entire life, and I know you're going to continue to do it. And I can't wait to have you back on the podcast in a year or whatever, and then see where you are now. And you'll probably be the CEO of Fengate or whatever. I don't know. I have so many more questions for you, but I also want to be respectful of your time. I'm so grateful. Thank you. I appreciate you being here. And God bless you, kiddo.
Oh, thanks, Dwayne.
All right.
This is awesome.
Thank you. Thank you so much. Thanks for listening. I appreciate you being with us. If you found value in the show and know a friend or a coworker who could benefit from the conversation, please share the link via text or on social media. Remember, each share creates a ripple effect of knowledge and inspiration. We'll see you next week.
The views, information, or opinions expressed by guests during the Dwayne Kerrigan podcast are solely those of the individuals involved and do not necessarily represent those of Dwayne Kerrigan and his affiliates. Dwayne Kerrigan or the Dwayne Kerrigan podcast is not responsible for and does not verify the accuracy of any of the information contained in the podcast series. The primary purpose of this podcast is to educate and inform. Listeners are advised to consult with a qualified professional or specialist before making any decisions based on the content of this podcast.